Here at Interflame Finance, we are holders of Nike stock. It's one of the largest positions in our portfolio, mainly to collect that sweet, sweet dividend at about 2.5%. But unfortunately, if you are holders of Nike like we are, we have seen devastation in after hours today. So Nike stock has been in the mid 60s, and they reported their earnings today after the closing bell, and they went down to the high 50s. So the question that we have is, what happened? Is Nike a buy? Is there something scary in the numbers that we should avoid buying Nike? Should we sell the Nike that we do have? What should be done with Nike? And so what we're going to do is we're going to look at what happened. Okay. Nike earnings. Nike stock down as lower quarter two profit overshadows beat. So shares of Nike fell in extended trading after the athletic apparel maker reported fiscal second quarter 2026 results, while Nike beat revenue and earnings estimates. Ongoing pressure on margins and direct-to-consumer sales led to a year-over-year decline in its bottom line. So earnings per share came in at 53 cents. What did the analysts think? They thought 38% on average, or 38 cents on average per share. So Nike demolished that. They got 53 cents per share, way, way, way above 38 cents per share. However, it declined 32% year over year. Meanwhile, quarter two sales increased by 1% to 12.4 billion and beat analysts' expectations of 12.21 billion. So they got about $200 million more in Q2 than the analysts thought. Now, Nike, if you don't know, had some bad leadership for a while. So Nike, it's past 5 days, it's down 3%. Past month, it's up 5%. Past 6 months, you're up about 9.7%. But if we look at the 5-year chart on Nike, we can see basically your stock price getting cut in half. Yes, you are getting dividends the whole time, but do those dividends really make up for the fact that if you had invested $137 back in December of 2020, that money is now cut in half? Some would say it's a rebound play. The bad leadership that they had for 4 or 5 years is out. And so now they have one of the original co-founding people of Nike as the CEO. And so Nike is going for a turnaround play. They're trying to fix what was broken, and they're trying to get back on their feet, which has attracted a lot of investors, such as us at Interflame Finance, back to Nike. So wholesale business remained the bright spot, with revenues rising 8% to $7.5 billion, driven largely by strength in North America. However, Nike Direct revenue fell 8% to $4.6 billion, weighed down by a 14% drop in digital sales and a 3% decline in company-owned stores. Importantly, gross margin fell 3% to 40.6%, mainly due to higher tariffs in North America. So these tariffs that we have on companies that do business overseas, like Nike, are really starting to hurt the Nike brand and other related companies. Moving ahead, inventory levels improved, dropping 3% to 7.7 billion. Cash and short-term investments ended the quarter at 8.3 billion. That is down 1.4 billion. However, they are paying that out as dividends, which as a shareholder you like. As a shareholder, you also like share repurchases. They are taking shares of the stock off the market, and that's going to drive up the per share value. And you want Nike to buy back shares. If you are a shareholder of Nike, you want Nike to buy back their shares now in the mid 60s, low 60s, and now high 50s, because you suspect, if you're bullish on the stock, that price will go up. Also, they're paying out bond repayments, and capital spending outpaced operating cash flow. So we can see the analysts here. What do they think? It's a moderate buy. There's 29 ratings. The average is about $85 per share. The high is $120. The low is $68. Even the low has some upside, okay? Because we just saw that Nike's trading about $58 in aftermarket trading, and the low estimate is $68. Whether those will be revised in the coming days is to be seen. But what we're going to do here at Interflame Finance and Investing is see, what do we think Nike is worth? Is it a buy? Is it a hold? Is it a sell? And how do they stack up against their competitors? So many of Nike's competitors are growth companies. They are small in the apparel space, the athletic apparel space, and they are growing. Do they have a moat? Do they actually have a lot of room to grow? It's going to be very, very tough for companies like Decker and Lululemon to take away market share from Nike, but Nike is the big dog in town. And so we have 5 companies here. Nike being one of them. We have Decker, we have Lululemon, we have On Brand, and we have Crocs. And we are looking at their growth scores. I would say 4 out of these 5 companies could be argued as a growth play. We see their numbers here. We see PEG ratios for Nike and On Brand are respectable under 2. Remember, we typically want PEG ratios to be under 2. The lower, the better. Forward PE, the winners there are Crocs and Decker. We can see debt to equity. On Brand and Decker basically have no debt. As a matter of fact, 4 out of the 5 have respectable debt to equity ratios. The one being over 1 being Crocs, which we don't like to see with Crocs, which is why we see a score of negative 1.1. Return on equity, return on invested capital goes to Decker and Lululemon. Same with profit margins. We see revenue growth, EPS growth. Unfortunately, Crocs has negative EPS growth expected for the next 5 years, probably something we might want to avoid. Nike and On Brand are the winners for EPS growth at 14 and 20% respectively. So we at the channel here like the 5-year forward PE also as a brand new indicator that we've recently incorporated into our analysis, and Decker and Lululemon win those values. So the winners for the growth plays are Decker and Lululemon. There is one company that offers a dividend, and that is Nike. And so if we look at their safety scores, surprisingly, we see Nike right in the middle. We see Decker and Lululemon winning at 7.9 and 6.4. Now remember how we score stocks on this channel. They range in value between negative 10 and positive 10. Negative 10 is absolute garbage, worst company in the world. 10 is basically a perfect company. We want positive numbers first and foremost, but on this channel, we like to usually be a little bit more picky and pick things that are 5 and above. Lululemon and Decker would be the only 2 companies winning that for both growth and safety. And you can see why for Decker, okay? Decker, they win the PE battle, they win the debt to equity battle, they have the best return on invested capital, they have the best return on assets, they have the best free or second best free cash flow yield, and they have the best 5-year forward PE. Okay. Nike is the only company that offers a dividend at about 2.5%. They've grown their dividend about 6.62% this past year, and they are 2 years away from becoming dividend aristocrats, meaning in 2 years, if they can do it, they will have grown their dividends 25 consecutive years in a row. Okay. The problem is they have payout ratios of about 78%. So there's this big question mark of, is Nike going to be able to keep increasing their dividend year over year for 2 more years to become that dividend aristocrat? That remains to be seen. We will see. Only time will tell. So we have growth scores and we have safety scores. We also want to get an idea of what their intrinsic value is. So if you've gotten anything out of this video so far, please leave a like, subscribe to this channel. We're growing this out. We are giving free, awesome analysis on these companies. Of course, we're not giving any financial advice. We are not financial advisors. We're not saying to buy any stock. We are not telling you to sell any stock or hold or anything like that. We are just doing this for entertainment and educational purposes, just to give you an idea of how you might want to approach your own due diligence and your own research in the market. So in the description below, we have 2 intrinsic value calculators that I built out on this channel, and I show you step by step how to make these spreadsheets. So the first one is a PE multiples ratio, where we project the earnings per share out 10 years. We scale it back with a discount rate. And this third line, we also look at the forward PE for 2, 3, 4, all the way up through 10 years. And we can see here that Crocs is not looking too good, okay? Crocs is expected to shrink 3% per year for the next 5 years, and nothing looks too terribly good about Crocs. As a matter of fact, their current PE is 29, and their forward PE, basically for every single year for the next 10 years, is expected to be higher than 29. So probably not a very good play. We can see that the current price is $89. According to this model, it should probably be trading for somewhere closer to 24 based on those numbers. Okay, but we're going to look at something like Nike. We'll put Nike in the spreadsheet, and Nike is expected to grow about 14%. We're going to put 12 just to be careful and conservative. And we are going to give it a discount rate of 8 because Nike is a solid company. Okay, we can see the PE ratio is currently 33, 34, and that's expected to go down, down, down for the next 10 years. We like to see that. We'll also note that for years 1 through 5, we assumed a 12% growth, And on this channel, we want to be very conservative and very careful. We are going to cut that growth rate in half for years 6 through 10 at about 6%. So we can see that Nike is basically fairly priced right now. Now, Nike, this price is outdated. It's currently trading for about $58. We will take that into consideration when we do our intrinsic value margin of safety calculations. But for right now, it looks like Nike is basically trading fair valued. Now, if you look at the dividend discount model, which is also modeled in the description below, you can check that video out and see step by step how to build out something like this. We can see that Nike, based on its dividend growth and its current dividend, requiring an 8% return on our money, Nike should be trading for $116. It's currently $65 according to Google Finance. It'll be updated in the morning at $58 if that after hours trading holds. So that's a very nice margin of safety of 44%. So when we compare Nike and its intrinsic value to its four competitors, how does it shake out? What's a buy, what's a hold, and what's a sell? So because we are looking at both growth and safety scores, we are averaging them to get the total score, the total average score rather. And again, we like things to be 5 and above on this channel. And the only two that come in are Decker and Lululemon. Nike comes in at about a 2.9. So not too terribly encouraging for our numbers. But when we look at the intrinsic value, the other four companies seem to be overpriced. So for example, Decker's intrinsic value is $96. It's currently trading for $98 after hours. I did update these numbers to reflect their after hours values. And so Decker is basically trading fair value, about a 2% premium on Decker stock. Same thing with Lululemon. It's intrinsically $189, currently trading for $215. You're paying about a 14% premium if you were to buy Lululemon. If we take the two models for intrinsic value for Nike, the dividend discount model and the PE multiples model, we see that the intrinsic value should be around $91 and it's currently trading for $59. And so that gives us a nice 35% margin of safety. And so if we had to buy athletic apparel stocks and we had $100 to do so, the only one that we would buy based on this analysis is Nike. We would put at Interflame Finance $100, 100% of our money into Nike. It's the only one that has a positive margin of safety. Not the best scores, but Decker and Lululemon are potentially quality plays. We want that price to come down. When we see Decker in the low 90s, when we see Lululemon in maybe the 160s, the 150s, maybe we would take another look at those companies. But for right now, even though it has a score of 2.9 on average, Nike is the winner. And so at Interflame Finance, I think what we'll be doing is waking up tomorrow. If Nike is still beaten down, we will be making a move into Nike and increasing our position, and we're going to try to buy this dip. Nike is in a regrowth and a rebranding. They're trying to fix the mistakes of the past. And so based on that information, based on the beats on the top and bottom lines, we think that Nike is a buy at these values. Again, of course, we're not telling you to buy or sell anything. We are not giving you any sort of financial advice. Always do your own due diligence. Appreciate you. Like and subscribe. If you got any value out of this video, tell your friends. Thanks for watching, and I will see you in the next video.